Difference between GAAP and IFRS. IFRS is a set of standards developed by the International Accounting Standards Board, IASB. It merely provides guidelines for harmonizing standards and unifying accounting processes around the world. IFRS is used in the European Union, South America, and parts of Asia and Africa. GAAP is a set of principles that US companies must follow when preparing their annual financial statements. It is an authoritative approach to accounting that ensures that there are no inconsistencies in the financial statements filed by listed companies with the U.S. Securities and Exchange Commission, SEC. This allows investors to intercompare the financial statements of various listed companies. Key differences between IFRS versus GAAP. Inventory valuation. Generally, GAAP permits inventory valuation using the last in, first out, LIFO, method. IFRS does not permit the use of LIFO and requires the use of FIFO or weighted average cost. Development costs. Under GAAP, development costs are capitalized only after technical feasibility has been established. IFRS permits capitalization of development costs under certain conditions, including the possibility of future economic benefits. Intangible assets. GAAP often has more stringent recognition criteria for intangible assets. IFRS tends to recognize intangible assets more flexibly, focusing on whether it is probable that future economic benefits will accrue. Leases. GAAP. Previously, leases were classified as operating leases and capital leases. IFRS adopts a single lessee accounting model and treats all leases similarly. Financial statement presentation. GAAP generally follows a more rules-based approach and provides specific guidance on how to present financial statements. IFRS is principles-based and provides more flexibility in the presentation of financial statements. Example. Consider a company that uses the LIFO method for inventory valuation, which is acceptable under GAAP, but would need to switch to FIFO or weighted average cost when reporting under IFRS. GAAP. Let's have a look on pros and cons of GAAP, generally accepted accounting principle. Pros. Established and widely used in the US, detailed rules provide clarity in accounting treatment. Follows the more conservative historical cost convention. Cons. Rules are complex and can be rigid. Because the LIFO method is allowed, it may not reflect economic reality during inflationary periods. IFRS. Let's have a look on pros and cons of IFRS, International Financial Reporting Standards. Pros. Principle-based accounting allows for more flexible interpretation. A single global accounting standard increases comparability. Reflects economic substance rather than legal form. Cons. Less detailed guidance, which may lead to different interpretations. Differences in local practices may make implementation difficult. Which is more appropriate for the current financial era? Whether GAAP or IFRS is more appropriate depends on a variety of factors, including the nature of the business, global operations, and regulatory requirements. In the current financial era, where companies often operate globally, IFRS is gaining popularity due to its international acceptance and the push for harmonization of accounting standards. Status of adoption in various countries. As of January 2022, more than 120 countries, including the EU, have adopted IFRS to some degree. GAAP is used primarily in the US, but some countries have incorporated elements of both GAAP and IFRS. The number of countries adopting IFRS may change over time. Thanks for watching. Don't forget to like, subscribe, and share it with your friends, and relatives. Thanks for watching. Don't forget to like, subscribe, and share it with your friends and relatives.